I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Today's guest has just taken over the reins at a business that has always aimed to be a company that people find easy to work with and enjoy dealing with. Having been around long enough to have met and interviewed all three of his immediate predecessors, I can attest to this. Despite being at the head of a key global reinsurer, all those leaders were always open, accessible and down to earth. Very much the sort of executives who you imagined answered their own emails and organised their own diaries. So I'm happy to report that Clemens Jungsthofel, the CEO of Hannover Re, represents a continuation of his firm's refreshing and highly individual character. When you buy reinsurance, at the most fundamental level, you're buying life insurance for your insurance company, as you protect your capital base from potentially fatal losses. It's not a relationship you enter into lightly. It's much more like a marriage than a simple business transaction. That's why cedants seek out reinsurers who are strong, stable, steady, consistent, discreet and trustworthy, whatever an unpredictable loss landscape or the rollercoaster ride of the market cycle throws at us. Listen on, and I'll wager you can hear Clemens projecting these qualities in the same way his predecessors did. What you see is what you get. The son of an insurance agent, Clemens is someone who has insurance running through his veins. He's one of us, and exudes an air of calm unflappability. It's easy to imagine entrusting him with a trade secret, or admitting you really need his help. What follows is a very timely, broad and deep discussion of the state of the market and Hannover Re's strategy within it, as well as a thorough examination of the short and long-term industry impacts of phenomena as varied and diverse as the major changes in insurance distribution and AI. Here's someone I found the business of recording a podcast with extremely easy and pleasurable. I think you'll find listening to it equally pleasant and incredibly useful. Before the industry heads down to Monte Carlo for its annual meeting, I can highly recommend this episode as a primer for all the major talking points. Enjoy the podcast. Clemens, welcome to the Voice of Insurance.
Thanks so much for having me, Mark. I am actually a regular listener of your podcast, so it's a really pleasure to be finally part of it.
Oh, well, you've got a very good reason to be part of it. You're now the new CEO of Hannover Re. And of course, as a regular listener, you'll know that one of the things I always do at the beginning is as I ask people to introduce themselves. It's something I've learned to do over the years, because not everybody knows everybody. We sometimes in insurance and reinsurance, particularly in reinsurance, as the world gets smaller and smaller, we think we know everybody, but we don't always know, and we don't always know the interesting histories. And the more we delve into our histories, we tend to find more things we have in common, which I think is always interesting. So for anyone who doesn't know you, who hasn't met you before, can you just briefly introduce yourself to the audience?
Yes, happy to do that, Mark. And I'll probably do that by way of sharing two facts with you that you will not find in my CV. It's probably the most interesting part, but they do reflect my deep connection to the industry early on and to Hannover Re later on. So the first fact is that it's actually no coincidence that I started my career in insurance, because my father ran an insurance agency, which he inherited from my grandfather. And since the agency was based in our home, I quite literally grew up with insurance. In fact, I always joke I began underwriting unusually early, probably around the age of 10.
Was it a big name, or was it one of the sort of regional mutual, or one of those? And were you doing all the sort of, household, small farms and, motor and all that kind of stuff?
Yeah, exactly. It was a regional mutual, quite an established mutual firm. And my father was running an exclusive agency for that firm. And I hope that the German regulator or the PRA are not listening to this, because I was back then helping my father issue moped plates. These little metal tags that you could stick on your moped, and that came with an instant policy. And he even would let me collect the premium. And I always joke that might explain actually the finance part later in my career. And that was really early on. And reflecting on it back then, one particular case, Mark, really stuck with me, talking about insurance and how I came into it. I remember vividly a client coming to us on a Sunday morning while we were having breakfast. And he was really warmly thanking my father and handed him a gift. And what happened was, just weeks earlier, he had bought a fairly new car. And the client insisted on just buying basic third-party cover to save some money, because he had spent it all on the car. But after some advice from my father, he opted for full coverage. And at least for the first year, my father had told him he should do that. And then he had actually crashed that car. And he would certainly not been able to afford a new one. And that was probably my first lesson about client service, about risk assessment, and, to be honest, and the importance of being properly insured. That was really sort of my first encounter. And then after finishing school, I trained as an insurance agent myself. I studied economics, whilst my younger brother did a fantastic job in growing that agency, which he still runs today, by the way. And I then joined KPMG, where I exclusively worked with insurance and reinsurance companies for about 20 years, 2 years of that in the London insurance market, KPMG. And that mark brings me probably to the second fact that you won't find in my CV. My first encounter with Hannover Re was not in 2020 when I joined as CFO. It was back in January 2002 when I was a junior auditor and consultant at KPMG, and I joined the audit team here in Hanover of KPMG back then.
Wow. So you know everything about the company. If you've been running through everything and looking for any problems and hopefully not finding too many all that time, then yes, by the time you joined, you'd done all your due diligence on this business.
Yeah, and it was really interesting to see. I said to my predecessor, the CFO, Roland Vogel, back then when I joined, I said, Roland, the reason why I joined is to find out the secrets that you were hiding before your auditors. So that made for a good laugh.
Absolutely. So you always, on the accountancy side, you're more on the audit of insurance companies, and or you more on the kind of actuarial side or the more kind of consulting side? Obviously, now a business like KPMG, they have so many different facets to what they do. There's the kind of, change implementation side of a business as well.
Yeah, and it was really a holistic view on the client. I mean, we provided both audit consultancy services to our clients, also actuarial services. And I was very much interested in getting to know the whole value chain of an insurer or a reinsurer. And that was probably the reason, and given my background, that there was no escape from me from the insurance or reinsurance industry. And I always said when I was fed up at KPMG with, some of the internal stuff, I said, I'll just go to my clients. I really enjoyed that part.
So this is the sort of question I already know the answer to, I think, but I think I should ask you. So do you think there'll be any change of management style now that you've come into the role? Should we expect to see any changes in emphasis or the style at Hannover Re under your leadership?
Looking back at 2002, Mark, when I first sort of met the Hannover Re guys, I had already seen, I would say, a fair number of large insurance companies, many with complex structures, layers of management, endless committees and things like that. And what often struck me was a bit of a lack of client focus with many of these large corporations. But after just 1 week here at Hannover Re in the office, it was immediately clear to me that these guys are really somewhat different. And this 100% client focus, the drive to always find the best solutions for the client, the pragmatism, this pure speed of decision-making. So clearly these qualities stood out. And when you combine that with the flat hierarchies, with the humility and the genuine kindness, I would say, I just enjoyed it so much to work with these guys here at Hannover Re. And I should add, that was despite the fact, Mark, that they always gave me a hard time on audit fees. Because the lean operating model comes with a laser focus on cost, as you can imagine, and that's so deeply ingrained in the DNA. So when it comes to management style and direction, I've always been a very strong supporter of this somewhat different approach of Hannover Re, I must say. How we work with our clients and how we work together internally here. It's not just because it's so enjoyable. I truly believe it's the secret sauce behind our success. It's something that you don't have to put on a slide. It's really, you live and breathe it here. And that's not really just my view. It's the consistent feedback I hear from clients and brokers around the world. And that's, when it comes to direction and change, that's why we're 100% committed to continuing on this successful path. And as for our current strategy, I've worked very closely with Jean-Jacques, with my predecessor, from day one. It's been a true privilege. I really want to learn from him, especially Jean-Jacques. He's a true team player. And we really developed this strategy together, collectively, as a management team. And at the midpoint of it, I can confidently say we're fully on track. That said, we can't afford, of course, to rest on our laurels because as we continue to grow with our clients, the team and I will ensure that we really stay true to our distinct, somewhat different approach. And I'm
I can attest to that laser focus on costs and no wastage. Because I remember meeting Jean-Jacques in his hotel room in the Hotel de Paris at Monte Carlo and having one of those sort of quick 25-minute meetings for a podcast I was doing. And the previous meeting, none of them had eaten the food. And there was these little mini hamburgers. They were really rather nice. And he said, Mark, you must eat these. You must eat these. We can't let these go to waste. You know how expensive it is at the Hotel de Paris. Of course, they were delicious. And so it was one of those ones where I thought, this is it. This is the lean operating model. And it worked very well for me because I got some hamburgers out of it. So it sounds like, yes, not much change because that culture is so ingrained. That's why I kind of preempted that question by thinking I already knew the answer. What about the market then itself? This market you've got to face, it looks like the hardening has now run its course. So how do you get growth in a market like this?
Well, coming back to the feedback I gathered from clients and brokers over the last couple of months, during the transition into the new role, one of the themes that came through very loud and clear was that clients and brokers genuinely enjoy doing business with Hannover Re. And also that they want to do more with us. So looking at the broader environment, if we look at ongoing loss trends, the macroeconomic, geopolitical environment, and the ever-widening protection gap, I think the demand for reinsurance remains very strong. And we all share the goal of narrowing the protection gap. And Hannover Re, I think, is well positioned to contribute to this meaningfully. And we are fully committed to growing alongside our clients and expanding also our share of wallet with our partners. And I think today, even more so, we can say we are doing this from a position of strength. Our balance sheet is really rock solid. Our capital position, I'd say, has never been stronger. And it gives us the flexibility to deploy capital in what I would still consider an attractive market environment. And our focus remains clearly on profitable growth. You will have heard that in the past. This is anchored in risk-adequate pricing and sustainable terms and conditions. So it's not growth for the growth's sake, but a deliberate effort, I would say, to build an even stronger and more resilient book of business.
So it's about trying to deepen those relationships that you already have, or do you want to go and find new ones? If you want to increase share of wallet, for example, it sounds like that's doing more with your preferred cedants, the people that you've worked together and you'd be able to grow profitably together. Is that more the strategy rather than trying to find new things or new customers?
I think it's both, Mark. I think it's fair to say that the growth that we've seen in the last 5 to 10 years has been fueled predominantly by increasing our share of wallet. And I think there's still plenty of room for us to grow. But there are also other areas and new clients. When I speak to brokers, they would say, well, Clemens, you haven't even seen a large portion of our clients. So why not doing more on that side? And, particularly in the structured space, in the structured reinsurance space, we have all sorts of clients and possibilities to grow our business and also find and help clients coming up with tailored solutions. So that's usually a good entry point also to get into touch with new clients.
I suppose where rates are adequate, profitability has been excellent. As I say, most of the CEOs in your position who I talk to would say the same, that they want to do more of this good stuff. When capacity has now fully been rebuilt and appetites have been rebuilt and everybody wants to grow, well, they want to grow profitably, absolutely. But how can you increase the share of wallet without giving something in return?
Yeah, I think it's consistency. Again, we're not chasing top line, for the sake of it, but really, I think it's just this trustful relationship that we have built over many, many years with our clients. And the feedback coming back to that is very much consistent on, well, Clemens, Hannover Re has always been just very upfront, very clear in terms of the risk appetite. And I think it then comes back to the speed of decision making. It's just the ease of doing business that clients and brokers would always talk about. And it's so easy to do business with you, and the flat hierarchies and the empowerment of the underwriters allows just for that deal certainty. And I think that's an element that is very appealing to our clients. And that leaves us still, with the opportunity to gain market share, which we still do.
You have that good relationship with those clients and those brokers because you have more touch points, because they can talk to you more quickly. You have a more dialogue because you get back to them quicker. Obviously, something you'll be fully aware of. Let's say one of the big grand theories of this resetting we've had of the reinsurance market in the last 4 years and the resetting of its profitability, which has been a very good thing, has been the resetting of attachment points to a much higher level. Obviously, you'd be aware that a lot of those students, of course, would like you to find some kind of solution where you can come back down a little bit closer to the risk. Of course, a lot of them have been forced to retain that risk and have learned a lot more about that risk because it's a risk that often, I suppose, in the preceding 20 years, they were able to cede away. And therefore, because if you cede something away, you don't really think about it quite so much. It's not your problem, I suppose. Now that they've really grappled with this problem, because it's been an intense focus for them because they've fully retained that risk, do you think we're getting closer to a stage where you can find a mutually agreeable way of meeting that demand that's there because they want more of that frequency protection? They've always wanted that and they want to benefit from that, more of that earnings protection. Obviously, we know that all reinsurers are there for capital protection. But do you think we're getting closer to a point where you can be happier going into those types of arrangements because we understand the risk better, because we know the demand is there?
I can see that it's going to be part of the discussion, also in the next renewal, etc. And it's also true, I guess, that we had a couple of good years. But let's not forget, it was probably just 3 years ago when I was sitting in front of very frustrated investors, were rightly critical of an industry that wasn't earning its cost of capital. And it was absorbing, in their view, way too much risk, especially frequency losses. And that exposure, I think, often masked the fact that pricing wasn't adequate in the first place. And while when we just look at purely at 2025, while Q2 has been relatively benign, the year started with a tough reminder of volatility. With the California wildfires and other loss events showed that there is clearly uncertainty coming with some of the perils. So naturally, as competition increases, yes, attachment points and retentions will come back into the conversations, but they are just one of many levers, I would say. So for us, the principle is very clear. We will remain cautious about lowering attachment points unless, pricing really fully reflects the increased risk. But I think these attachment points, that discussion came into the renewal 1/1/23 for good reasons. And this is essential, not just, for our own portfolio, but I really believe for the long-term sustainability of the market.
And of course, last autumn, we're only a few days away from a very large hurricane hitting Tampa. And, we could be talking a very different story. And I suppose to summarize your point of view is, of course, if we're not producing these respectable 15% type returns regularly, then who's going to reload this industry? If we're only able to return 6.5 or 7 or 8, they'll say, well, why would I bother with this industry? It doesn't seem to make any sense. You can have $100 billion loss and you're still going to only prospectively return 8, 9. It doesn't seem to make any sense. So again, I suppose that's not necessarily a sustainable business model, is it? Is it a good way of summarizing your argument back to those cedants, saying, don't forget, we need to get this right together?
Yeah, exactly. I mean, I think the discussions have to take place, of course, with the primary insurer in the first place. And we need to make sure that we all are doing this on a sustainable basis.
Yep.
Because that's what we're here for.
And so apart from that desire to get more earnings protection, where do you think most of the demand is coming from cedants?
Well, when I look at our growth over the last couple of years, I think that growth has been fairly diversified. We've seen particularly strong momentum in Nat Cat business over the past few years. Demand from clients remains robust. Our risk appetite in that space is aligned with that demand, provided, of course, that pricing and conditions stay adequate, of course. We also have a strong track record in facultative reinsurance. We are well positioned to capture further growth in that space. Our expertise and, that responsiveness that I touched on earlier continue to resonate very well with clients, particularly when it comes to tailored solutions. And in addition, therefore, our structured reinsurance solutions play a key role for clients managing earnings volatility and capital. Particularly the earnings volatility is an element where we see demand. You touched, Mark, on attachment points, etc. So whilst some of our clients just try to find solution to manage that increased volatility a bit, that can be by way of structured solutions, which have been a good discussion point with some of our cedants in the past. So that's basically, I think, where we see still quite healthy demand.
So there are solutions then for the earnings volatility question, you're saying?
Yeah, and by way of, if we think about multi-year contracts on the structured reinsurance side, that's something that we usually offer our clients. And again, the fact that we always try to come up with a solution, my colleagues always say on the P&C side, we never say no to a client, but we always say no, but, and try to find a specific solution that can be by way of such a contract.
Yes, you mentioned about the facultative division, which I know has been a very big growth engine for you in the last few years. Of course, the thing about the facultative, it's so much more responsive. If the market hardens, you see facultative demand go through the roof very quickly. If the market softens, also in reverse, demand tails off. If the treaty market is the kind of futures market, the fact market is the spot market. It's about what is happening today in the market right now. So what's that fact market telling you at the moment?
Yeah, I think it's always a good indicator of the general market environment. And again, that's generally, I think it's clear that prices are softening at the moment. We do see signs of softening, particularly in loss-free property cat lines. There's a strong supply of capacity, also when we look at the fact market. So the market remains what I would call still rational. So in loss-affected business, we see still meaningful rate increases. So it's rational behavior, while other lines are renewing rather at, I would say, relatively stable levels. And then again, terms and conditions and retention until now largely unchanged in nominal terms.
Obviously, another rational thing to do when the market softens, if you're a buyer, of course, is to buy a bit more, because often in the hard market, you buy as much as you can, but sometimes there's only so much you can buy because capacity is tightened. Everyone's favorite 3 words at Monte Carlo would be new top layer, that kind of thing. Any more demand to buy bigger limits, reinstate some of the limits that they had prior to this hardening cycle that we've had?
Yeah, it really depends on the line of business you're looking at, the region you're looking at, etc. But again, happy to engage in any conversation with our clients when prices and terms and conditions are adequate. But it's clearly part of the discussion that we expect.
Within that partnership with your cedants, often the interesting thing that we have, obviously the insurance world and the reinsurance world are different worlds. They're still connected very, very closely to each other. But often you have a time when there's a general consensus between insurers and reinsurers that they're all agreeing on something. And at other times there's a disagreement. What's that consensus feeling like? Are there any lines where there are disagreements? Because sometimes, big cedants can say, well, you have a different view of this than I do. I'm much more optimistic than you, so I'm going to retain this. And so, it's been really nice working with you, but I'm going to keep this risk to myself now. Are you getting those kind of conversations or any of those kind of feelings with cedants that there's any difference of opinion around fundamentally about cat risk or about US casualty, that kind of thing?
Yeah, just briefly commenting, Mark, on the topic of, partnership, which is very dear to my heart and very dear to us at Hannover Re. It has always been more than a buzzword. At Hannover Re, it's really a genuine commitment, which we do live and breathe. And while that can sound, I would say, a bit abstract or even fluffy on paper, it becomes very tangible when you speak to clients and brokers around the world. So it's one that is very dear to my heart. When it comes to the consensus on or agreements, disagreements, I think as reinsurers, it is our responsibility to clearly communicate our view of the risk to our clients and to ensure that we have a shared understanding, being close to our clients and engaging that discussion on the back of that partnership approach, that long-term partnership approach is fundamental. And I think for us as reinsurers, it's fundamental to be part of the solution and remain a reliable partner, which we've, I think, proven to be in the past. And that will then allow us to keep rates and terms and conditions, I think, long-term at appropriate levels and offer the best possible capacities to our clients. And I think, Mark, in your interview with Jean-Jacques last year, you both used the term equilibrium to describe that ideal state of the market where both reinsurer and cedants benefit. And I believe that by January 1, that we still have that level.
And I suppose with the partnership, of course, you need to pick your partner, don't you? Of course, you get to know each other. And then if you find that you both have fundamentally different views on certain things, then I suppose you can't really be a partner, can you, long term, because you've chosen the wrong partner at that point. But I suppose if you've been reinsuring the same cedant for 20 to 30 years, you already know that you like them because you already agree on the big questions. You're only going to disagree on very small things and small details here and there. But fundamentally, I suppose you found that partner and they found you because you have a concurring view on most things, or certainly on the big important things.
Yeah, and having that honest debate and, creating that trust, I think is something that is of utmost importance to us, having a trustful relationship and having an open discussion. And then, as always, Mark, as you rightly say, you either depart or come to a solution. And we tend to find a solution together with our client.
Of course, when there is disruption in the market, then that's usually when you find out the value of that partnership and you find there are moments when some people are surprised. And I suppose it's your job to give those loyal customers as few surprises as possible, I suppose, isn't it?
Absolutely. Our clients don't like surprises, neither do we.
I was thinking back to that Jean-Jacques Monchot interview, and I think one of the things he said was that, of course, real partnership comes at a price. There's a difference. If you want the best partner, and I suppose he was espousing that ambition to be the best partner, I think the market of first resort was how he described it. You want people to say, look, if I could do things with Hanover, that would be great. If we can work together, that would be fantastic. You want to be top of people's list. That was the ambition. Is that still the case? And that therefore that you could command a premium because you're Hannover Re? Is that the ultimate ambition?
I mean, clearly you want to be competitive, but still, I think, Mark, that is even more true. So as we are growing, because I think we want to be the go-to partner that, our clients think of when they have a problem, they try to address a problem, that they think of Hannover Re and pick up the phone and say, well, these guys are usually coming up with a solution. They are easy to deal with. And that's our go-to partner. That's very much our approach. And when I think, and Jean-Jacques will have said this, when I think of client centricity in that sense, I think really offering the whole firm and being joined up as Hannover Re, coming up with solutions, regardless of where in our business, I think that's what I would call client centricity.
Okay, within those friendly partnerships, of course, we do have occasional differences of opinion. And the one that probably we've been talking about the most in the last few years would be the relative attractiveness or not of US casualty business. What's the feeling at the moment? And are we arriving at a new consensus on this?
I think compared to previous years, we are seeing some improvements in more recent underwriting years, driven by rate increases and tighter limit management. So that is encouraging, I'd say. However, underlying trends do remain elevated. And one question is, whether there is probably an abundance of caution in reserving for newer years, given the negative experience prior to 2020. And then the disruption, of course, caused by COVID-19 further complicates the picture because frequency data is difficult to interpret due to lockdown-related slowdowns. And then you have the post-lockdown catch-up effects and broader trend shift. So unfortunately, Mark, it will likely take a few more years to get a clear indication of where things are headed. And despite some positive signals, it's still too early to confirm that recent underwriting years will ultimately hold up well. So given the general deterioration that we've seen in the past.
So it's not bad news, but it's not necessarily good news for anybody either. And caution still rules the day. It sounds like it's not as if you're going to suddenly announce that, we are increasing our appetite for US casualty, for example.
No, we are happy with our current appetite and we watch this continuously and engage with our clients, but we haven't changed our appetite at all.
Well, one big thing that's really happened around the world, but obviously being Hannover Re, with being so interconnected into the global economy all over the place, for the first time we want to ask somebody who's generally got a reasonable position on this, because you're in relationships with so many countries around the world, how are you beginning to go about changing your models or thinking about the long to medium term effects on our sector of the imposition of tariffs on much of the global trade that we do with the USA?
Well, let's say without commenting on specific political decisions.
No, I don't want to talk about the politics. I want to talk about the reinsurance reality. It's far more interesting.
I would say really, as you said, Mark, reinsurance is a global business. And we've built our business model very much on the principle of international diversification. So trade barriers, tariffs, or broader trends of deglobalization, they do pose significant challenges to this model. They increase the cost of doing business by restricting capital flows and making our operations ultimately more capital intense. So from a business perspective, these developments tend to make reinsurance more expensive and less efficient over the medium to long term.
What about things like loss costs, particularly in the US? If you're rebuilding a house, some parts of it are bound to be imported. So presumably it's just going to be more expensive. And therefore you have to feed that into your model and say, well, that means a Florida hurricane is going to cost more than it would have done otherwise, for example.
Absolutely. And I'm sure that has been part of, the sort of the pricing considerations already during the year, how inflation, social inflation generally, but how inflation and those trends will impact pricing. And, and all that being said, that's ultimately detrimental to the policyholder. So that doesn't help us to narrow the protection gap.
And of course, reinsurance is at the heart and insurance is at the heart of trade. Again, you have any thoughts, if your chief economist has any thoughts on how this will affect trade? If you're a marine underwriter, will there be less ships sailing around because there's less trade?
Yeah, we haven't seen that yet fully. Again, we're watching this. We're concerned generally, on any of those developments, because again, coming back to it, it is ultimately detrimental to the business model. So we're watching that. Again, we haven't seen any immediate effects yet, but we need to be watching this.
Another question is about traditionally, if growth gets a little bit harder to come by in the market in an organic sense by increasing prices, for example, we turn to consolidation. Do you think we're entering a period of that? We've had some activity recently.
Well, generally, that could clearly be something that we observe in the market. Speaking for Hannover Re, I would say we've always managed to grow organically, never rule out any M&A. However, there are plenty of opportunities for us to organically grow the business. So therefore, why on the P&C side, we've never really looked at an M&A. It doesn't really change. So for us, not really a big topic.
Well, I suppose where you did do some M&A was in the London market to enter the Lloyd's market. That market is very exciting at the moment, very interesting. I feel lucky to be living in London at the moment because there's so much stuff going on, innovations and algorithmic trading, digitization. Obviously, you're in the market, but you also have very strong relationships with all the players in that market. And I'm sure you have strong reinsurance relationships with most of the players in that market. Most players in the London market are now looking towards automatic follow, algorithmic follow, the sort of broker facility type follow, or the automatic following facility method of underwriting, portfolio underwriting, hopefully to lower their cost of capital, to improve their expense ratio, and to embrace a more efficient way of doing business in a syndicated market, which obviously can be very expensive if everyone was having to behave as if they were a leader, even if they were only writing a 5% following line on something. First of all, what's your view of this development? Do you welcome it? And then how do you think it's going to change the market in terms of its dynamics?
Yeah, when I look at this segment of the market, for us, the main question is really around granularity of the approach and how a client can embed this from a risk selection point of view into their portfolio management or their risk management approach. So if you look at, for example, algorithmic underwriting, this often comes with well-structured and high-quality data, a defined box to describe the risk appetite and an underlying pricing model, which is consistently applied by this algorithm. The other end of the spectrum are portfolio solutions, which require a different set of controls, probably similar to delegated authority business. So both can work as long as we have transparency about the approaches and transparency of the data to assess the underlying risk from a reinsurance point of view. So a good example of that is probably our insurtech and digital underwriting practice, in which we are specializing to assess a variety of those approaches, including the ones you've mentioned in your question.
What's that experience been for you? Because obviously you have made some substantial investments in resources in insurtech. Say, for example, we've been talking a lot about AI, and everyone's been experimenting with AI in different parts of their business. What have been the experiments that have been the most successful for you in terms of either improving skill of underwriting or improving the efficiency of underwriting?
Well, we could spend probably hours on this, Mark. We can't open the newspaper without reading about AI, etc. I'd really like to think of AI as more a team approach. Technology in general, I would say, and clearly AI should enable better decisions. We should not replace them. So the human touch, as I like to call it, remains essential. That might be me being naive about it, but I think professional judgment, that long-standing experience and that sense of long-term partnerships, I think they are just very core to how we operate. And that's why I think sort of a joined up approach between technology, AI, and the underwriter and our people is something that I clearly see as a positive. So speaking about AI and what are these use cases, I think if you look at some of the companies in the non-financial or financial space that have managed to use AI, most of them spend years in getting the data and the infrastructure cleaned up in the first place. And that, for Hannover Re, for us, leaves me optimistic because that focus on reinsurance has led to the fact that we basically have no legacy systems. So we have fairly harmonized infrastructure and data space. And I think we can really use that opportunity. You can clearly throw a lot of money at AI initiatives. So the big question for us is how we can invest in an efficient, in a clever way, and focus on initiatives that are really scalable. I think that's the ultimate question. We've therefore focused our efforts on operations in the first place. So where we can use AI as an extension of our automation initiatives. So really increasing our operational efficiency, for example, in the space of technical accounting or claims management. But still, I think on the risk assessment side, sort of on the pricing, there are plenty of opportunities that we will see in the future. So I guess we all have that moment, Mark, where we've used some of the large language models and we're thrown in a question and thought, oh, how did this thing just did this? So therefore, I think it's also important to really invest in upskilling our people and giving them tools to learn, to try out.
It sounds like you want the people to be in there talking to the machine, not like some sort of black box that just says the number is 5.3 and maybe you as the underwriter think that it should probably be 3.9, but you can't talk to the machine and you can't really understand how it got to 5.3. But if you were embedded with that machine, and if you were a technically minded underwriter, which I'm sure most Hannover Re underwriters are, and you were kind of embracing that AI and using it to augment your decision making, then I suppose you would have a better understanding of how it got to that number 5.3 because you kind of had a dialogue with it and had helped build that model in the first place. I suppose the worst thing could be where you end up with a black box and no one really knows why it's doing what it is, even though most of the time it seems to be right, except when it's not.
Absolutely, Mark. And I think that's it. That's ultimately, I think, the game changer, combining that forces. Having AI skills itself is not a value in itself. So you need to combine that, with the underwriting skills, probably with actuarial skills, with IT skills, and then really seeing, what problem are you trying to solve and applying that in a most commercial way.
In terms of the dynamic of that digitized marketplace, and in London, I'm talking to people and saying, well, how much of that business will be led in a more traditional way? And a broker, of course, wants to have a leader and an alternative leader and probably a second alternative leader to be around and aware of that risk and being more traditional in the way that they support that risk. But then once that's kind of done, the high added value part is done, then 30, 40, 50% perhaps is a number that we're talking about of could be automatically placed and just done, just settled quickly. Do you think treaty reinsurance negotiations could go the same way, particularly when we get that strong quality of data running all the way through the insurance value chain? And of course, we all know that it's not there yet, but we can probably see that it is coming at some point. Do you think that's a likely similar outcome for reinsurance?
I think what we do see is what I would call transformative. I think it's fair to say that there is immense potential to improve speed, to improve transparency, and I guess the overall client experience. So it reduces operational drag and allows market participants to really focus more on insights, on innovation, and on outcomes. And clearly, as a lean and fast reinsurer, as Hannover Re, we do welcome this evolution, provided it's built on solid foundations. So robust data governance, underwriting discipline, and a clear understanding of risk. I think that's why we invest significantly into our digital capabilities.
So you wouldn't run away from that. Obviously, I'd talk to some CEOs and say, well, we're always going to be a leader. We are Hannover Re. I mean, why wouldn't we always be a leader? It sounds like you're a little bit more agnostic. Because ultimately, whether you're leading or following, you're taking a risk in return for a premium, and you better be happy that that is a good premium and it's the right premium for that level of risk and that it's going to produce the sort of returns over a long period that you feel it needs.
Yeah, I mean, having said this, with all the advancements in the technical space, clients are still interested in long-term holistic relationships with their reinsurers. And clearly, that high level of differentiation that they get from their reinsurers. So therefore, we don't expect such a model that will change the underwriting solution in general entirely. But I think you have to be aware of it and on top of things. But again, coming back to that long-term relationship that an underwriter has over decades, I think is non-replaceable.
In terms of that dynamic, if I talk to any reinsurance broker, even as far as maybe more than 10 years ago, they would say, what the market these days is, if the market clearing price is 7 rate online for this layer, for example, if I come in at 6.9, I get 0% place. But if I come in at 7, I could place 180% of it. And that's the way the market is, that it's become more homogenized. Do you think it's only going to become, in that sense, more similar, that we'll have a market clearing price and then it'll be very clear what that is. Once everyone's decided what it is, then placing becomes very straightforward.
I think the operational side of it, we all can improve on that and making it more efficient. And I think that's our responsibility, both on the client, on the broker side, and as a reinsurer. But again, when it comes to assessing the risk and having that long-term relationship, not being opportunistic in and out, having a consistent risk appetite, and coming back to our earlier conversation, Mark, on no surprises. I think that always will have a huge value in that client relationship.
As the market fluxes, there's always a change in the dynamics of the way that the business flows around the world. Obviously, your Hannover Re, you probably get to see it almost wherever it is in different channels. One of the big fluxes that often happens within the E&S market in the US, where we have this interplay between the admitted lines and the E&S market, and then, of course, the global excess markets out in Bermuda and London, for example. Now that the market's turned a bit, what's your view of where those business flows are going? Are they sustaining, or are they dropping off a bit, or perhaps even going into reverse?
I think that move towards business shifting to excess and surplus lines will continue as the regulatory environment limits flexibility to some extent. I think that's still the case. While standard products in the admitted market have their place, especially in commodity lines, like, for example, personal and commercial auto or homeowners, I think the industry sees more and more business requests that require some, what I would call, customization of coverage, which is easier done in the E&S market space. And while regulators do have the desire to keep a viable admitted market space, complexity in the risk landscape is increasing.
We all know, I mean, you referred to that wildfire in residential property in LA would have been a very vanilla risk. And obviously we wouldn't have been thinking about wildfire 30 years ago in those places. And now, of course, we are. And so therefore it's a dynamic risk and it needs a dynamic response. And therefore it's something that's unlikely that a very consumer focused regulator is going to be able to get their head around this idea that things have to move around and have to change quickly. So it sounds like you think it's more of a secular or a permanent change. And of course, there will be some cyclicality around it, but there's a permanent direction of travel that the kind of tide is moving in one direction.
Yes, that's how we see it at the moment, Mark. Yeah.
With that, something that's gone hand in hand with that has been the growth in MGAs and more distribution by MGAs. And again, that's something that's been through a couple of cycles. And there were times it might feel like there's a bit of a bubble in the amount of MGAs being formed. And then we had a hardening cycle. We had a bit of a clear out. But of course, those better MGAs have all thrived and continue to thrive. And we've had a large growth in the amount of premium being underwritten in that way. Do you think that's a similar secular change?
Yeah, I think with the growing MGA distribution, we have seen many carve-outs of portfolios that are now addressed individually. So while in parts it allows a focused look at certain exposures, it also adds a layer of cost to the distribution that needs to be dealt with. We've seen instances where the mere bifurcation of portfolio segments has not really led to improved overall economics, and thus rendering the MGA approach as not advantageous due to really increased cost levels. So we would generally think that it will become increasingly more difficult to further bifurcate bigger portfolios and to create opportunities this way. So less desirable risks still need to be placed, and risk sharing mechanism of diversification of larger portfolios also has a value. Whether or not we are at the peak or near to it, we will see within the next couple of months, I think.
When I talk to people in that space, of course, they would say that digitization of the marketplace has allowed for a democratization of the value chain. So, well, perhaps in the old days, every time you add, in a very crude sense, if you add another pair of hands, an MGA, a broker, another MGA, another relationship, you're always adding 10% extra cost because of paper, just the amount of paper and quarterly accounts having to be moved around and money being moved around in a very inefficient way. With the digital world, you remove all that friction. You can isolate those little bits of value. So, well, where is the value created in this value chain? Well, of course, the underwriting skill is really important. If someone's willing just to be an underwriter for a living and live off the amount of value that they add as an underwriter, their argument is, of course, that there's very little frictional cost difference anymore. But you're saying that there still is, that you're not seeing that feeding through into your end.
Yeah, I think that, again, this shift, I think, is quite significant, and we do see this as transformative. So really reducing operational costs and drag on the operational costs is crucial. And we do see that coming through. I think everyone has to do the homework at his ends. So we clearly need to make sure that we remain efficient. And again, Mark, that's why we are investing also at our end, and coming back to my initial comments on the somewhat different approach. So that lean operating model is something that we will defend clearly.
Yeah. And I suppose the economics of the economics, you're the one sitting at the end of the chain. So your net premium is always the smallest number, isn't it? So if it doesn't add up for you, it doesn't add up. And so you won't support it. So if there's too much fat in that chain, it can be squeezed out, because clearly we do have the technological means at our disposal, or at least coming to our disposal now, where you don't need to have to keep adding 10% every time you add another pair of hands.
Yeah, no, absolutely. I mean, being cost disciplined is true for everyone in the value chain, and the business always needs to meet our margin requirements, and costs are part of it. So we better be efficient and cost conscious. And again, so deeply ingrained in our DNA, so we will make sure that we remain so.
Well, I'll be seeing you down at Monte Carlo. We don't have a meeting in the diary because we're doing it now, Clemens, which is far more efficient. So I'll be looking forward to seeing you in one of the lobbies and waving at you and chatting to you there very, very briefly, but not on the record. So until then, one last thing. Do you have any message for clients down at Monte Carlo? Anything you're particularly going to be majoring on when you're out talking to everybody? What do you want to be reminding them of?
No, it's really, when it comes to Hannover Re, I hope I've made that clear, that I'm fully committed to stay true to this somewhat different approach. That clients still in 12, 24 months say to me, Clemens, we still really enjoy doing business with Hannover Re whilst we are growing. And I think that's very much it. I mean, we have a strong capital position. We have a fortress balance sheet. We are happy to deploy capital, but prices have to be adequate. But really that commitment to grow together with our clients, grow together, be consistent, be upfront about our risk appetite, and building that trustful long-term relationship is something that I will clearly deliver that message to our clients and to our brokers. And that's very dear to my heart, Mark, as you can sense. So that's very much the message that I will be taking to Monte Carlo, and really looking forward to seeing you there also, Mark.
Excellent. I shall see you there, and time to sign off. And I'm sure we'll be booking in another call this time next year. I certainly hope so. Thanks very much, Clemens.
Absolutely. Looking forward to it, Mark. Thanks so much.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience, because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.